Welcome to High Street Asset Management's 2024 Market Review and Outlook. My name is Ross Beckley, and I am the Chief Investment Officer. Firstly, just to reiterate our purpose at High Street, we are an offshore and rand hedge specialist responsible for globally diversifying South Africans' investment savings. The case for offshore investments is twofold. Firstly, a structurally weak rand, as can be seen in the chart on the left. The rand has depreciated by 5.6% per annum against the US dollar since democracy in 1995. This largely follows the inflation differential between the two countries over the long term. The second reason relates to underlying market performance, as can be seen on the chart on the right-hand side. While the South African JSE was one of the strongest markets in the world leading up to 2010, offshore markets have significantly outperformed since then, primarily driven by the S&P 500. All in all, the S&P 500 has outperformed the JSE by 4.5% per annum in rands since 1995. While it can be argued that the JSE is set to outperform the S&P 500 over the short term off a low base, we expect the trend of offshore market outperformance to persist. The primary drivers of this being a structurally weak rand, relatively strong GDP growth in offshore markets, and high levels of innovation, especially within the US. Outside of these tailwinds, it is important to note that South Africa makes up less than 1% of the global market, and investors should be cognizant of the opportunity set outside of our borders. 2024 was yet another strong year for markets, following on from the success of the prior year. The graph on the left shows the performance across major asset classes and includes High Street's returns across our offering for the year. Most notably was the sustained outperformance of US markets relative to the rest of the world, with the S&P 500 returning 25.5% versus only 6.1% for the rest of the world. Other standout performers during the year were gold, achieving a dollar return of 24%, whilst on the other end of the spectrum, global property and bond markets performed poorly, delivering flat to slightly negative returns respectively. Given the recent underperformance, we see opportunity in these asset classes moving forward for our balanced fund mandates. Moving on to currencies, shown on the right-hand side chart, it was another standout year for the US dollar, appreciating considerably across almost all currency pairs. Worth noting, the rand exchange had a decent year, holding its own with most other currency pairs. Offshore equity market performance was largely driven by the US over the past decade. The US equity market relative to the rest of the world is depicted in the chart. The orange line shows the relative price change between the two regions. As can be seen by the rise of the orange line, US dominance over the rest of the world began in the years following the global financial crisis of 2008, with the S&P outperforming by nearly 200% over the past decade. To determine whether the outperformance is justified by underlying fundamentals, we look to the line in blue, which shows the relative earnings per share growth between the two regions. While the US has grown quicker than the rest of the world, it is only in the order of approximately 70%, 130% less than its price outperformance. As a result, multiple expansion has been responsible for the bulk of US market outperformance. As can be seen in the table towards the bottom of your page, the S&P traded on essentially the same multiple as the rest of the world going into 2010. Fast forward to today, and the US is trading at an 80% premium, the highest level it has been since the data became available in 1998. With analysts forecasting similar levels of growth for both regions over the next 5 years, investors need to question if the premium is justified. High Street believes the US deserves to trade at a premium, owing to the strong cash-generating ability of these companies, and the depth of innovation leading America and the world into the next industrial revolution. Innovation driving productivity gains cannot be underestimated for the benefits they bring to both countries and companies. However, a premium of 80% is too wide, and by our calculations, the US would have to outgrow the rest of the world by approximately 5 to 10% per annum over the next 5 years to justify its current premium. With the Magnificent Seven stocks having comfortably beaten forecasts over the past 5 years, we believe this is not an impossible task. However, it seems rather unlikely. As such, from a top-down perspective, providing rough insights into market valuations, we believe the US as a whole is currently overvalued. But importantly, we do not subscribe to it being in bubble territory. Importantly, the innovation gap between the US and the rest of the world should not be overlooked, and select opportunities still present themselves on a bottom-up basis. The Magnificent Seven stocks have been a key driver for US markets, especially since 2019. Looking at the orange line on the chart, the Mag 7 have outpaced the rest of the S&P 500, termed the S&P 493, by an astonishing factor of 6 times. What's more, this has been substantiated by relative earnings outperformance of nearly 7 times over the period. Looking at valuations in 2019, the Mag 7 stocks traded on a multiple of 42 times relative to the S&P 493 of 20 times, a premium of just over 100%. Fast forward to today, and that premium has shrunk to 75%, owing to the strong earnings growth of the Mag 7 stocks. This premium is set to unwind further as the Mag 7 5-year forward growth rate is forecast at 13% per annum, relative to the rest of the S&P 500 at only 8%. Given the superior growth profile and arguably better business models, we believe the Mag 7 can at least perform in line with the broader US market over the next 5 years. If history is anything to go by, we believe there is a reasonable chance that the Mag 7 will continue to beat forecasts materially, which would likely result in a resumption of the outperformance of the S&P 493, albeit to a lesser extent when compared to the recent past. This slide delves slightly deeper into the valuation of the Mag 7 stocks. Given the strong outperformance, the Mag 7 stocks now make up 32% of the S&P 500, up from 18% only 5 years ago. As such, making the correct call on the Mag 7 basket of stocks will have a large bearing on how you perform relative to the market. Using one of the most common valuation techniques, the PE ratio, we can see that Mag 7 stocks generally trade on a 20-something 2-year forward multiple. Not overly expensive given their superior growth profiles and cash generating abilities. As per High Street's internal valuation models, we expect a 5-year forecast annualized return of 10% for the basket as a whole, even higher if you exclude Tesla. Worth noting that whilst our IRRs have proven to be statistically significant in forecasting future returns, they are only indicative of upside potential and represent a snapshot in time. Most important for us in determining prospective returns is the rate of growth and margins that a company can achieve relative to their expectations. As such, High Street is paying close attention to the return on investment and incremental growth that ensues from their massive capital expenditure projects. A lot of their future growth hinges on how persistent the artificial intelligence theme proves to be. Moving attention to local markets, 2024 was another decent year for South African securities. Moving from left to right on the chart, the JSE Top 40 returned 11%, driven by SA Inc., delivering a very commendable return of 21%. This contrasts to the poor performance of Rand Hedge shares as the collective, which were down 10%, as can be seen in the light blue bar. Rand Hedge shares on the JSE primarily comprised of consumer and diversified mining counters, which were flat to down for the year, in line with their corresponding international peers. We have previously detailed how High Street Asset Management prioritizes strong internal Rand hedges. These are companies with over 70% of their revenue derived in foreign currencies and less than 30% of their operations here in South Africa. For example, we consider Bidcorp a strong Rand hedge, while Amplats is an example of a weak Rand hedge. Looking at strong Rand hedges, they fared better than Rand hedges as a collective, delivering a 5% return in 2024, as highlighted by the orange bar. As per High Street's internal valuation models, the diversified miners and consumer-facing stocks, for example, Glencore and Anheuser-Busch respectively, are attractively priced at current levels. Accordingly, we have been using the weakness seen last year to increase exposure in our South African mandated funds. Barring some short-term valuation movements, we believe Rand hedges are poised to continue outperforming the SA Inc. counterparts, especially those with strong Rand hedge qualities. Inflation and subsequently interest rates form the bedrock of financial markets. As such, it is very important to take stock of where we are in the cycle. Inflation continues to moderate from the COVID stimulus measures introduced in 2020. Last year, inflation and interest rates followed expectations, with the Fed initiating a cutting cycle and reducing short-term rates by 1%. Forecasts for the current year are for inflation and interest rates to moderate further, albeit at a slightly slower pace than before. Inflation is expected to reduce from 3 to 2.5%, with short-term interest rates following suit, declining from 4.5 to 3.75%, where they were at the start of the year. We agree with consensus as the Fed must adopt a hawkish stance to manage inflation down to their target level. While not positive for the economy or bond markets in the short term, it is necessary to control the US's runaway finance costs, which now amount to 17% of their budget, compared to 5% just 5 years ago. Positively, we believe long-term interest rates will start coming down within the next couple of years, as the market reassesses the inflationary outlook, which will be supportive for the economy and bonds as an asset class. Following on from the prior slide, we see opportunity in the global bond markets. The yield to maturity, or annualized yield, on US bonds is currently 4.8%, which is near highs last seen some 20 years ago. Factoring in a range of interest rate forecasts from the leading macroeconomic research firms enables us to produce a spectrum of expected total returns, including both yield and capital gains or losses. Our base case is for US bonds to generate an annualized return of 5.8% over the next 3 years, with a bearish forecast of 3.4% through to a bullish forecast of 7.7%. Under the base and bull cases, bonds are expected to produce equity-like returns with considerably less risk. While correlations between equity and bonds fluctuate considerably and are often positively correlated, it is useful to zoom out and look beyond the statistics. During years where equity markets have declined, bonds have only followed suit on 3 occasions, going almost 100 years back. This makes them a very useful diversifier in a balanced portfolio, especially with the generous yields on offer. As such, We currently have 11 and 26% bond exposure in our local and global balanced funds, respectively. This is spread across investment-grade positions in quality companies and low-cost, well-diversified ETFs. To conclude, we end off with our outlook and positioning based on the conviction that we hold across asset classes and regions. This is based on a 3-year investment horizon as per our internal bottom-up analysis with a top-down overlay. We are neutral on equity with a somewhat expensive US market offset by the valuation unlock story that we see in the rest of the world. We are positive on bonds for the first time in many years, especially when viewed in the context of a balanced mandate, where the return objective can be met with a lower allocation to equity risk. We are positive on listed property due to increasing top-line rental growth, fixed financing for several years out, and attractive valuations in the form of both significant discounts to book value and generous dividend yields. Long-term structural drivers of shareholder returns in the property market are driven by GDP growth and inflation lifting top-line rentals, which is very much what we are currently witnessing. However, short-term share price movements tend to be driven by large movements in interest rates, which have provided an attractive entry point into a compelling structural long-term thesis. An honorary mention must be made of gold, trading near all-time highs of $2,900 an ounce. It is notoriously difficult to value, but its price is generally dependent on the level of real interest rates and prevailing sentiment. The marginal buyer over the past couple of years has been central banks, accounting for over 20% of demand, a level not seen since the late 1960s. Central banks generally purchase gold to protect the reserves from inflation, but many commentators suggest that they are looking to reduce their reliance on the world's reserve currency, the US dollar. With sticky levels of inflation and heightened geopolitical risks following Trump's inauguration, we remain fairly constructive on gold, especially as a diversifier within balanced mandates. Moving on to regions, we are neutral on the US, with the cash-generating ability and innovation within these companies justifying somewhat of a premium valuation. However, we believe the premium of 80% is simply too great and it is likely to unwind slowly. On a top-down basis, we are positive on the rest of the world. However, while valuations are very attractive outside of the US, we employ a bottom-up approach where the investment thesis and company fundamentals must corroborate a top-down analysis. Based on this, we still see the best long-term potential gains in US names, as fundamentals generally trump valuation. However, we are slowly increasing our exposure to non-US counters to benefit from their depressed valuations, provided they meet our fundamental criteria. Thank you for taking the time to listen to our market review and outlook. For more fund-specific insights, please see the individual PDF slide decks attached and also available on the High Street website. As always, we pride ourselves on being approachable with direct access to our fund managers. Please feel free to contact us should you wish to discuss anything further or schedule an in-person meeting.